Good morning and welcome everybody to the August IMAP webinar. This is really a topical session today and I'm looking forward to it because, as you'll see, it's about portfolio construction and manager selection in a fully valued environment and a volatile environment. What I want to do before I hand over to our two presenters today, Michael Karagianis from JANA and Jordan Cvetanovski from Pengana, is talk a little about IMAP's upcoming events. Last week we ran the first of our 2019 portfolio management conferences, and over the next couple of months we really have quite a lot going on within IMAP. On the 29th of August in Sydney, we're running the second of our FinTech cocktail evenings. And we'll be focusing there on a portfolio analytics. So we have two really interesting presenters, Foresight Analytics, a Sydney-based fintech, and a company, JHC Neon, who'll be talking about fintechs and their use in analysing portfolios. That's at Stone and Chalk, and we'll be promoting that over the next couple of days. 17th of September, we'll run the third of our Responsible Manager Masterclasses for this year. So if you're involved in being an RM on a license, this is really a day which you might find useful to attend. And then in October, the 22nd in Melbourne, we'll be running our second Portfolio Management Conference. In Sydney, we concentrated on the higher level issues around portfolio management, asset allocation, manager selection, risk management, portfolio construction. But in Melbourne in October, we'll be thinking much more about individual security selection. So Australian equities, international equities, bonds, and really the lower level, sector level portfolio construction issues. And I'd encourage you to think about attending that. Then in November, Investec. The other thing I just wanted to mention is our data standards group. We've published the first of our data standards now, which represents IMAP's contribution to ensuring that there is a standard across the whole of the industry for the provision of data from managers to platforms. And now we're moving into phase 2 of that, which is looking at some of the other data transfer issues. Let me just move on now to contextualize today's presentation. What I'm showing on the screen is MSCI Global reaching back 2 years, their monthly returns. As you'll see, we've operated over the last 2 years, as you'll know from client feedback, in a volatile market environment. A range of returns from -6% to +6%. And there's no sign that with trade wars and currency contest, there's no sign that that's going to be any more settled over the next 24 months. And so today's session is really an opportunity to talk about portfolio construction. We've got two very different presenters, an active stock picker in Pengana, thinking about picking companies that'll provide robust ongoing returns for investors, and an asset consultant looking at portfolio construction and manager selection in a global sense. The first presenter today is Michael Karagianis from JANA, and it's my pleasure to hand over to Michael and ask him to take us into this interesting and exciting topic. Thanks, Michael.
Thank you, Toby, and thank you for the opportunity of presenting today. In many respects, this is a continuation of the topic that was covered at the recent portfolio construction conference that IMAP hosted, and we were very pleased to present at. I'm senior consultant at JANA Investment Advisors. We're one of the largest institutional advisors, but I guess our involvement with IMAP over the course of the last few months is reflective of the fact that we're now looking to offer our services into the advised market in Australia, and to really draw on a lot of the lessons that we've learned from managing $500 billion odd of institutional money, how it can be applied into the managed account space, what needs to be changed, perhaps to cater for the particular requirements of advisors in this space and their clients. So from that in mind, really, I guess I just wanted to give a sort of an investment asset allocation 101, and that you probably have seen this presented before, but in our view, really the focal point of consulting is about getting the right objectives embedded within client portfolios. So clients in our case being advisors that we're engaged with, getting those right objectives in terms of the return objectives, the risk profile, and risk profiles can be determined in a number of different ways. The incidence of negative returns, an SAA framework, a pure objectives-based framework. But invariably that comes down to spending a lot of time getting the asset allocation right within the portfolio. And I guess it's a truism that people understand that asset allocation is most important. But it's interesting still when we engage with clients, including advisors, that most of the conversation seems to be focused around the question of active versus passive, manager selection. In reality, in our view, over a full investment cycle, that probably contributes maybe 10, perhaps 15% of the total return of portfolios. The asset allocation that you actually apply to portfolios, either the SAA or the tilts that you apply at various stages of the investment cycle, are going to dominate returns, and not enough time is really given to that in portfolio construction. So the two principal themes I really wanted to cover off on today are the question of active versus passive. What role does passive have within portfolios? As opposed to active? Does that change over an investment cycle? And really, how much more thought we should give to asset allocation, particularly as we approach the late stage of an investment cycle where traditional asset classes in many cases are quite fully valued. Equity markets are not cheap as in total, but we also see defensive asset classes like bonds at multi-decade lows. That does present problems for traditional AA investing. Are there other asset classes that we need to think about in this sort of context? Passive versus active, firstly. This is something that we see talked about a lot in the managed account space. There's a great deal of focus on trying to deliver managed accounts at a very cheap price point. We often hear, how can we deliver an investment solution at the same sort of price point that industry funds are producing investment solutions at? And hence the passive conversation invariably comes into play. I'll talk a little bit more about this, but our concern is that particularly as we approach the late stage of an investment cycle, excessive use of passive strategies can produce an inherent risk within portfolio construction that investors at least need to be aware of and perhaps start to adjust for as we move through an investment cycle. Why is this the case? Well, if we focus largely on equity risk, which dominates multi-asset portfolios, passive strategies are effectively dominated by capitalization. You look at indices and they are basically driven by outperformers. And as you approach the end of an investment cycle, of course, it's been those outperformers that have generated returns steadily over a long period of time that occupy the majority of the index. And they can often be the ones that undertake the greatest correction when the turning point actually occurs. So from that point of view, passive strategies can actually become more risky towards the end of the investment cycle as opposed to the earlier mid stages of the investment cycle. And that does perhaps give pause for thought as to how you actually construct manager portfolios as you move through an investment cycle. This chart, I think, perhaps illustrates that quite nicely. And the dominance of equity risk, and hence how much time we need to really consider how we build the equity piece of portfolios. If you have a look on the left-hand side here, you've got a classic 65-35 type portfolio, I think, which has been traditionally called a balanced type strategy in Australia. It's anything but. Next to that, what we've got is actually the contribution to risk. If you actually look at the contribution of volatility, or the potential for negative returns, it's largely driven by the equity piece of the portfolio. So a portfolio that has a benchmark, say, of 65% to equity type investments can actually generate volatility from that part of the portfolio up to 90 to 95% of the total risk of the portfolio itself. So it is largely an equity portfolio, even though there's still 35% in defensive assets. Look at a less risky portfolio, more of a moderate type risk portfolio that we would look at or conventionally see invested in Australia, a 50-50 type portfolio. You would expect that this type of portfolio would have really quite defensive characteristics. But even in this case, over a full investment cycle, research has shown that that can have 85 to 90% of the volatility of equity markets. And of course, in very distressed market environments where volatility actually increases, that can actually spike higher than that. So what this shows is that getting particularly the equity part of the portfolio right, and as you move into the latter stage of an investment cycle, really focusing on manager selection, how you actually build the equity piece, the proportion of passive versus active strategies, and maybe looking for diversification into other asset classes becomes much more important and perhaps needs to be thought about, particularly in the current market environment. Solutions to this, increasing active management in portfolios later in investment cycles. The caveat being that, when I talk about active management, I think what we're really meaning here is high conviction, perhaps more benchmark agnostic strategies, where managers have the ability to significantly depart away from benchmark and particularly focus on more defensive characteristics within portfolios. So if we move to a later stage of an investment cycle, which is traditionally dictated by lower aggregate returns, you tend to see more dispersion of returns within asset classes, more tendency towards downdrafts in investment markets, then having managers that can actually provide a risk buffer within their asset class by introducing more defensive type characteristics can become much more important. And in that regard, perhaps being cautious about excessive passive strategies is a useful consideration. There has been the rise of smart beta strategies. I won't spend too much time on this today because I think it's really a topic unto itself. But looking at more systematic ways of investing where effectively it's not so much active management, but it's looking at alternative type benchmarks that you're actually investing against. So equal weighted is probably one of the simplistic versions of this. Rather than looking at a cap weighted index, you actually invest in a strategy. It might be an ETF where there is a simple equal weighting across the investment universe. And what that has tended to show is in certain market environments, particularly ones where there is an increasing bilateral volatility and greater subject downdrafts in markets, it can actually provide greater defensiveness. The other exposure that we would perhaps look to focus on at this stage of an investment cycle is increasing exposure to alternatives. And I did want to spend a little bit more time on this because there's a lot of misconceptions. There's a lot of preconceptions about what alternatives are and how they can be employed within portfolios. And I think it's probably an area that can usefully be explored to provide greater information to a lot of investors. Case for alternatives, getting the allocation to the right sort of asset classes is absolutely fundamental to portfolio construction. As I showed on that earlier chart, so much of our portfolio exposure is dominated by equity risk. And as equity markets become fully valued, we move into a latter stage of an investment cycle. That's problematic. Traditionally, we would move into defensive asset classes, but in the current environment with interest rates at historic lows, does that actually provide sufficient return? You're sacrificing a lot of potential return to try and protect capital. And of course, it may produce its own risk. So bond markets, for example, can actually produce capital risk in this environment if bond yields were to spike over the course of the next couple of years. So looking at alternatives can be a useful strategy to incorporate within portfolios generally and also within managed accounts. What we do need to be very careful of, however, is that when we move into alternatives, often the risks become much more idiosyncratic. So if we're investing in equities, what we can probably say is that generally 90% of the return that we're going to get is the market or beta risk, and there is going to be some alpha that is generated by managers, and that will be, give or take depending on the type of strategy that the managers are running. In alternatives, so much of the return is actually tied up with the manager itself. And in that regard, manager skill can actually dominate the total performance. So no two alternatives, even if they're in the same category of alternatives such as hedge funds will necessarily deliver the same performance. Therefore, you need to really look at manager research very carefully in this space. Manager research is very much intrinsically tied up with the research of the strategy itself. Therefore, I consider that alternatives are not a homogeneous asset class. I think that's a popular misnomer. In fact, they're a class of investments. We need to really understand them in much greater detail, how they'll perform in different environments, what the manager brings to the party in terms of the way they manage that particular strategy. The common characteristics, however, with alternatives are that they either are providing one of two things. They're either providing a premium for illiquidity. So, for example, we look at asset classes such as private equity as opposed to listed equity. We look at direct property as opposed to listed property. The common theme is that they are illiquid assets. It's very hard to withdraw from them. But for that, you hope to receive a premium over a period of time. And certainly that's an approach that industry funds have used with great success through investment cycles. The other characteristic that we often look for in alternative assets is there's some form of diversification, so that we're looking for investments that provide a differential return stream, particularly away from equity markets. If equities are our principal risk, can we introduce other investments within the portfolio such that when equities actually hit an air pocket, these types of investments will provide some sort of ballast to the portfolio? And an example of that might be for gold, perhaps, where it does tend to provide defensive characteristics in very distressed markets. There are other investments in the alternative space that can do that, and they can add value at certain stages of the investment cycle. Common types of investments, and these are broad categories: private equity, as I've already discussed; infrastructure, we're talking particularly direct infrastructure here; hedge funds, they can range enormously in the types of hedge funds, what type of strategy they're pursuing; single manager hedge funds as opposed to multi-manager hedge funds, so it's a whole universe unto itself. Commodities, quite diverse. I mentioned gold tends to be inversely correlated to the investment cycle or the economic cycle. Other commodities such as iron ore, for example, are actually quite positively correlated to equity markets. So understanding the characteristics of individual investments in that space can be quite important. Timber, that's often looked at, particularly in overseas markets, not so common in Australia. Distressed debt, opportunistic debt, insurance-related investments. That's an interesting one because that is not governed by the investment cycle. It's very much more governed by the incidence of natural catastrophes, and can provide a very differentiated return, which can be quite usefully employed within portfolios. Each of these strategies are diverse from each other and can be diverse within themselves. So it's very important, as I said previously, to understand the strategies, particularly understand the managers who are actually managing those strategies to get a good sense as to how those portfolios or the inclusion of those strategies within a broader portfolio will impact. Important to be a little skeptical. I think one of the great failings of particularly fund managers in this space over a period of time has been overselling the virtues and probably under disclosing the costs of investing in alternatives. So, looking at it, how attractive are these strategies in terms of after fee type returns? How much are they biased to expensive assets? So if you look at the hedge fund universe at the moment, there are certain strategies in there that have done better than others. And one of the reasons for that is that a lot of them are actually, in effect, taking expensive beta bets on equity markets. That's not necessarily the sort of portfolio exposure you want when you already have equity beta in your portfolio. You can get it a lot cheaper through ETFs, for example. Why go into the alternative space and just replicate that? However, there are other hedge fund strategies that are much more lowly exposed to equity markets and perhaps even inversely correlated. Those are the types of strategies that might be more useful. Transparency, that's often a bugbear in the alternative space. We think that you need to have a very good understanding as to what the investments are today and what they're likely to be in future. Beta dressed up as alpha, it's not really manager skill. They're just simply investing long in markets, perhaps, and they're dressing up in perhaps a lack of transparency for you. And one important consideration, particularly for managed accounts, how much illiquidity can you actually build into the portfolios? When we're looking at endowment funds, for example, very long duration, they can afford a lot of illiquidity. Managed accounts, that may be a very different consideration. Final thoughts really on this space. Really, I think portfolio construction in an extended bull market, particularly the early to mid stages of an equity bull market, are pretty straightforward, pretty easy in effect. A rising tide tends to lift all boats. You could basically invest in cheap beta ETFs around the world, and as markets rise, you're going to get carried along with that. And whether you outperform or underperform, if markets are rising 20%, maybe that's a second order consideration. Manager alpha is nice in that situation, but it's not essential to deliver strong performance. Do you really want to pay much for risk management or insurance where your expectations are that markets can continue to rise in that sort of environment? Valuations are not particularly stretched. Therefore, quite understandably, keeping it simple and cheap is not a bad investment strategy. However, as you move into a later stage investment cycle, and it's always difficult to know exactly where you are in the investment cycle, this is currently a very elongated cycle. We believe it does get much trickier. There is overvaluation in many asset classes at the present time. That doesn't mean that there aren't opportunities that exist within asset classes, but simply investing in passive strategies may not be the best way of employing or capturing that opportunity set, and may in fact expose you to more overvalued parts of an asset class than undervalued. Therefore, beta is less well rewarded overall, and in particular, undiversified beta can be very dangerous in this environment, and that's something that we are particularly concerned about at the moment. In that regard, risk management may be more relevant. Now, I say may be more relevant because it really depends on the requirements of your client. There are some clients that, frankly, perhaps are a relatively early stage of an investment timeline. They don't really care about volatility. They're perhaps early stage accumulation, not an issue. But you may also have clients that are at a much later stage of the investment cycle, transitioning into retirement, perhaps already in retirement, where it is actually quite painful to experience substantial downdrafts. They're much more sensitive to risk, and hence employing risk management strategies could be much more useful in that situation. And I think looking in that type of environment for portfolio construction, employing quality managers that not only have a good track record in terms of delivering alpha, but perhaps also much more agnostic in terms of benchmarks in the way they manage portfolios, can be a very useful inclusion within portfolios. It doesn't mean that you don't have passive strategies, but maybe you need to think about the proportion between passive and active in that sort of situation. Thank you very much.
Yeah. Look, thank you very much, Michael, and thank you for that. Now, just a point that if you have a question down at the bottom of your screen, you'll see a Q&A button, and feel free to type in your questions for that. There's a question about the slides, and yes, we will be distributing these slides. So Michael's presentation was very much on a broad portfolio level view of responding to this late stage, more volatile market. Now we're moving to a single manager presentation from Jordan Cvetanovski from Pengana to talk about international equity investing and the challenges that it poses and how to respond to those. Jordan, thanks very much.
Thank you. Hello, everyone. I'm Jordan Cvetanovski. I manage the international funds here at Pengana. I've had over 20 years, approximately 20 years experience managing funds, but I'm your classic stock picker. I am your bottom-up guy that looks at companies, real companies that produce real things, managed by real people, and we basically aim to pick the best of these companies around the world and put them together in a way that makes a lot of sense throughout the cycle. Now, okay. Right. So 3 things I'd like to kind of highlight at the outset, and I probably want to leave you with. The first thing, I think the key thing in putting funds together and picking stocks is to not be carried away with the short-term kind of focus. It's very important to keep that eye on the longer term. And this is a key point when looking at opportunities, looking at the current situation in the markets, and it really governs the way we manage the portfolio and how we react to market conditions. The second thing I'd like to kind of highlight is that we see risk management or kind of maximizing risk return from a holistic perspective. We think of putting a fund together where there's two important things. One is the kind of companies you pick are very important, the characteristics of the companies, but also equally important is the way we put it together, so the portfolio construction. So in order to hit our aims of consistently making money, but at the same time minimize losses and volatility, we really have to get these two aspects absolutely right. So I'll talk to you a little bit about, and I know we're getting right into the weeds, it seems, immediately after Michael's great presentation from a kind of helicopter view of the markets and how things are going. But for us, this is our world. This is where we live. And it's of prime importance to get all of these things right. I was at a presentation recently, and having watched MasterChef over the last season, I came up with a kind of an analogy on this, and I think it's kind of like baking a cake. Now, don't quote me on any of this because I've never really baked a cake, but I think it kind of makes sense, because to get a nice cake, you need the right ingredients, which is the analogous to our stocks that we choose, and then you need to put them together in the right recipe, and you can't veer away from that recipe too far, or it doesn't work. And that is our portfolio construction methodology. So what are the ingredients that we put into our cake, if you like? It's the stocks. All of our companies have these characteristics, which I think not only maximize our return potential, but importantly, as we were saying, in a more volatile period that we've had recently and going forward, which is what we anticipate, will minimize our risk. So we need companies, most importantly, with great cash generation. Throughout cycles, I've seen fads come and go in terms of how do you value businesses? We think of businesses as industrialists. We think of owning companies. We think of the long-term return, cash return of our companies. What we aim to do is to buy them at the right valuation. So for us, valuation is free cash flow yield. So for us, how do you translate that into something that makes sense to everyone? Well, a free cash flow yield of 10% means you pay $100, you get $10 back, and over 10 years, you get all your money back and you own the business for free. Now, we invest in growing businesses because growing businesses are winners. So whether we think about investing in 1% return in government bonds or negative 1% in Swiss government bonds, i.e. you pay for them to take your money, or you invest in a business that's actually growing, has real cash flow return, and you get all your money back within a much shorter period of time. For us, this is not a question at all. This is how we think about investing in businesses. 5-6% free cash yield and growing 5 to 15% a year. Then we maximize returns and lower risk, again, by picking companies that have positive tailwinds. So companies with great secular growth factors. So we invest in the long term. I mentioned at the start, it's very important to look at the long term. So we invest in companies that benefit from broad themes such as aging population or emerging market growth. And I'll talk a little bit more about them as well. And ultimately, our clients give us their money. They assess us as our skills as a fund manager, and we take that money and we give it to, we buy shares, which effectively we give capital to management teams that we invest in. So we have to assess them and how well they've done in the past. So for us, we spend a lot of time on management teams of companies. We don't think buying equities broadly, you just buy a stock and you just wait to see what the gods of finance will deliver, in terms of beta. We believe in management teams that can create their own destiny and benefit from a downdraft in the cycle. And then finally, of course, we don't invest in companies that are more likely to blow up. Highly indebted businesses, companies that promise you the cure for cancer or whatever, that can go up 100% or down 50% in a day. This is not what we do. So we do the simple stuff, we get the simple stuff right, but it's very complex to get right because it requires a lot of work. And this is what a true stock picker will have to do in these times. And for us, what's important is actually how we put them all together. So we invest in concentrated portfolio of 40 to 50 stocks, say, on average. So how do we put it all together? So we aim to put together a fund that actually works well throughout the cycle. So for this, we need a core stable part of the fund that will deliver that consistency. So that is 60 to 80% at all times is invested in great quality compounding businesses that give you that consistency and low volatility. And within that, we try to diversify the kind of companies we have there. We'll have a company that that farms salmon, and a company that produces cork in Portugal, and a company that makes pacemakers in the US. None of those companies have anything to do with each other, but they will have that consistent kind of demand for their products over time. Then we venture out and we say, we're not just going to sit on our hands and kind of expect to get this kind of, just the 8 to 10% or whatever we can expect out of our core. There are cycles out there. There's great opportunities in buying companies when the cycle goes against them. So we are active and we step in when we see great opportunities. So when we put this fund together, the aim of this fund is to basically capture all the market opportunities that are out there in the equity markets, but at the same time, minimize as much as possible the risk within the fund. So Michael mentioned diversification a lot, and for us, diversification makes a lot of sense. And if you look at ETFs these days, and ETFs, when people talk about ETFs, they think that is the market. We say, okay, I'll just buy ETF, I'll buy the market. But if you really think about what an ETF is, it's essentially you're investing in another fund. The S&P 500 is a list of companies that you put your money into. It's another fund manager, effectively. So I think it makes sense for people to look into what they're actually buying when they're buying an ETF. And these days, with so much focus having been in the US market in particular, and within that, the tech sector and the utility sector, you're actually buying quite a bit of concentration within that ETF. But if you look at our exposure over time, we've made it a point to make money from all sectors within most sectors within our universe. There are over 36,000 companies out there, and we feel that there's great companies within each sector. In addition, as an active fund manager, we shouldn't just sit on our hands, and we should make a call when things get out of hand. For example, even though the market has approximately 30% now within the tech sector and the payments, Visa, MasterCard, or what have you, we will actively decide when enough's enough. So back in January 2018, for example, when things got over exuberant within the tech sector, we went from a maximum position within the tech within the tech part of our portfolio all the way down to approximately 3-4% of our fund. And we deployed that capital in other businesses that we consider to have just the same characteristics, but at a lower risk with a lot less concentration. Again, from a geographic point of view, a lot of focus has been on the US, but we've again, and I think it's very important for an active manager of a fund to look elsewhere, to really dig deep and find great businesses, both in Europe, which is a great big continent. It's been around for a while, has a lot of companies, a lot of high quality businesses out there. We shouldn't be painted all with the same brush. Asia, which and emerging markets broadly, which has great potential going forward. So it's imperative that we look broadly and we keep an open mind and look for the same quality businesses all around the world. In terms of market cap, again, a lot of the action has been on the mega caps, $100 billion plus within the US. But most of the value we see in the market are below that kind of range. And again, I want to now pause for a second and just clarify the general kind of tone of the discussion here, which is to say that, hey, markets are at a late stage, early stage, mid stage, expensive, fully valued, or what have you. We don't see the world the same way. We think at any one time, there probably is a point in the cycle where things get expensive in one part of the world. For example, the US broadly is fully valued, if not expensive. And within that, the tech sector and potentially the utility sector, which makes sense given the low interest rates, are overowned. And we feel there's been a lot of kind of capital flowing into those sectors, and it's becoming very dangerous to be holders of that space. However, it doesn't mean that the whole world is now expensive and we need to run for the hills. there is actually great value that we're discovering within the European markets, emerging markets, and also within the US, as long as we look away from those heated sectors. So very briefly, just to give you an idea of how we think about the portfolio construction, here are some of the examples of the stocks we have. On the left side, you see, on the left column, you see our core holdings. You'll see there everything there from Indian telecommunication companies to Mowi, which is a salmon farming business in Norway, to a cable company in the US. ASML does lithography machines, and without which, by the way, I don't believe Apple or many of the tech companies would exist, because they allow the progression of the next generation of chips to come out, so you get this improvement in technology. We have a car auction business in the US, health insurers in the US. All of these businesses do their own thing. They grow consistently, but most importantly, this is how we see diversification. Buy businesses that have nothing to do with each other, but they all have the same commonality: high quality, consistent growth. And that's, we believe, lowers risk. In addition, as a portfolio manager, I think Michael mentioned something about having alternatives as a way to diminish risk. Well, our version of that same concept is our investments in companies that would actually benefit from a rise in volatility. So back in January 2018, we started investing in market makers that would benefit from volatility increasing, hence volume increasing, hence pricing increasing for the products that they sell. And we noticed that we made 70% return out of that one company during the January-February volatile period of 2018. We expanded that view and we bought some great monopolies in exchanges such as CME Group, Deutsche Börse, and intercontinental exchanges. And we followed our kind of investment into things like Flow Traders and Virtue in the US, which actually benefit if volatility was to return in the markets. So again, this acts as a counterbalance to the general overall equity risk that our fund is exposed to. So this chart, this table here that we've included is to say that what is important when you take this approach in looking outside of the most favored sectors within the market is to be able to pick the right companies and to do well despite what the market opportunities are. So you can see our returns from the European market, ex the UK, over 4 years in existence of the fund. We've returned 12% out of a very, very stale market that is Europe, which has only returned 5% over that period per annum. So again, the key thing here is no matter what the markets do, find those companies that will give you that consistency over time. So observations on the market. Let's take our eye now away from the short term and into the long term. We think there's great opportunity in emerging markets. Population growth is where emerging markets are seeing the largest population growth in the world. Africa, Asia will see the biggest growth over the next 30, 50 years. This is where the biggest growth in the consumer will be, and this is where we want to be investing in companies that benefit from this growth, whether it's developed market companies benefiting from that growth indirectly or directly into emerging markets. Again, this chart shows you the action that we've discussed all along. Markets feel expensive, markets feel overbought in general, but most of that action has come from the US. US companies, simply put, have become much more expensive over the last 10 years. Looking elsewhere within the European sectors, European region and the Asian emerging market region, companies actually haven't gotten that expensive. So again, the broader market isn't, in my view, that expensive. It's the fact that the US has seen so much capital inflow. Volatility, again, has been low, and that's created this kind of view that as long as you just buy the market, if you like, you'll be okay. There's not much volatility in markets, therefore there's been quite a bit of complacency in how people invest, but we feel that volatility is bound to come back, and this is great for us and music to our ears, because suddenly you'll get that dispersion that Michael mentioned, and we think that'll work into our favor. I'll leave you with one example of how this strategy can work over time. We've only really had in the last 4 years one quarter where you've had a lot of volatility, and that is last quarter of last year, where markets fell 10, 12% over that period. But you can see that through successful diversification and stock picking, on the third bar chart there, the fund can actually exhibit some quite profound defensive qualities, but at the same time, over the 4 years, having captured that market opportunity broadly. So for us, how do we see the world? We think business as usual. Nothing changes for us. There's still great opportunities out there. We're seeing a lot of opportunities. We're invested as much as we can be at 90-94%. We keep finding ideas, and we think these companies over the next 3 to 5 years will deliver the returns that we expect them to. So key for us is make sure that we have enough diversification across regions, across sectors, have enough quality businesses that are not correlated, that will not all go down at the same time, and make sure we keep up the quality of the broader consistency of the funds over time. With that, I'll leave you to
Thank you, Jordan. Now, as I mentioned, if you have questions, and there are some here, you feel free to type them in. So a couple of questions. Let's deal with the sort of mechanical ones. CPD points. Yes, we will be issuing CPD points for today's session. A question to both Michael and Jordan. And let me just move our. I'll get the cameraman to move the camera a little. So to both of you, if you had $100,000 today with a global focus that you have, where would you be thinking about putting it?
I'll start with Michael.
Yeah.
Not surprised. Look, it's impossible to answer that without actually knowing what you're trying to achieve. I think that what you're probably trying to get to is where do you think that there is value in the market at this point in time? As I said, I think that in this environment, I would be focused on maximising diversification, and that includes diversification within asset classes by looking at manager diversification. So, as I said, reducing the number of the exposure to passive, perhaps looking at perhaps more defensive type manager allocations. There is a focus on value potentially that you can look at that has not been rewarded at all, but it could be a strategy moving forward where certain value managers could come back into play. Looking at alternatives as part of the equation, the overall weighting between them very much governed by what you're trying to achieve, the risk profile, the return objectives. Those are important considerations I think you need to bear in mind in this sort of environment.
Jordan, where does your $100,000 go?
Got it. I mean, if I didn't say into my own funds, then that would be kind of strange.
That's a given. Yeah. So where's the funds $100,000?
So look, the way I see the fund is this. This is what I monitor. I bring it always back down to simple things. I'm an engineer. When problems get more complex, you don't complicate them further by adding more complexity. You strip it down to the simple stuff. And the way I see it is basically this. The fund has a free cash flow yield on average of 6%. It's growing at 7% a year top line. It's got the combination of all the companies has hardly any debt, 0.5 times net debt to EBITDA, which means it has less debt than the overall S&P market, say. It's growing faster than the S&P. It's valued at a lower valuation than the S&P, which gives me confidence that over the next 3-5 years, our companies, which are high quality businesses, should outgrow and outperform the market over the next 3 to 5 years with a lower risk profile.
So let me ask both of you then, because I think this is...
As opposed to putting it in bonds.
That's right. Yeah. I knew that wasn't going to be the answer. So let me ask both of you then, what impact recession has. I noticed if we go back a little, Jordan, to your slide on market outlooks. So you're projecting here that the emerging markets, that industrial companies in general growing 1.5 to 2%. So let's say global growth comes in at less than that. and the trade wars and the currency wars turn out to engender a recession, what's the impact on either approach of recession?
Well, I think it's challenging for growth assets in that environment. I mean, if you argue that they are at least at a broad index level fully valued, then clearly that type of environment runs the risk of perhaps a significant underachievement in terms of earnings.
Yep.
And is the market likely to absorb that at the current level of valuation? I would suggest that we could at the very least see another bout of severe volatility. We could see a significant pullback in markets in that sort of environment. So to defend against it, obviously, if you knew it was going to happen, you would be taking money out of equity markets today and you'd be putting it into defensive asset classes. In that sort of environment, return of capital is probably more important than return on capital, at least for a period of time. The reality is we don't know exactly the probability of that. There is a non-trivial risk of a recession, but it is probably not the core scenario, at least at this point in time. And so from that perspective, diversification is the best way of defending. And diversification means, you know, looking at your exposure to the equity market, what strategies can you build into the equity piece of the portfolio to try and produce greater downside defensiveness if there was a earnings disappointment, but also in terms of the asset allocation itself, looking for maximum diversification there, looking for asset classes that can actually offset
Jordan,
that risk.
do you have a view in your portfolio of the likelihood of global or widespread recession, of the markets generally, of economies failing to hit the numbers that you've postulated here?
Oh, look, picking recessions and picking the tops in markets are not what I do. I think it's very difficult to get that right. But what I can say is that there certainly is, as Michael said, a non-trivial risk to things slowing down. And the trade war in China, with China, is expanding. You're getting similar kind of analogous kind of conflicts between the most export-friendly countries, which is Japan and South Korea at the moment. So you've got to be thinking the biggest advocates of global trade are having it out between each other. You've got to think what's going on. Will this continue and develop into a currency war and into another kind of and get worse and worse over time? That's certainly not good for most things. I'd say most asset classes. We don't operate with that as a core belief. What we say is, let's find those companies like a salmon farming business that will not need. So what's salmon? Salmon consumption grows 4 or 5% a year. There's no more places you can grow salmon. This is the biggest company in the world. Yes, it's a luxury product. There might be an impact, but overall, over time, you'll be okay. I'm not saying all of our holdings are immune to global slowdown. There will be some that will be impacted, and broadly, the portfolio will be impacted. But if you invest in equities, you have to believe that these equities represent companies. Companies grow over time, so they should go up over time. Okay, so we have that. You have to start with that as a starting point. So we think the companies we hold right now will grow over the next 3, 5, 10 years, and that should provide capital returns. But there are external factors that we cannot control, and they will impact the performance of the fund.
There's a question here from one of the audience on sustainability factors. At IMAP we ran an ESG roundtable recently, which we're just about to publish the proceedings of, and certainly it's a major issue for many investors and the clients of many advisors. So, Jordan, how does sustainability and sustainability issues impact the fund?
Well, it's a great question, and I'm glad it's been asked because I didn't think I was going to be talking about sustainability, but our funds, I've always, even back in Paris when I was managing money, I managed it in what I thought to be an ethical way. And we manage ethical funds here at Pengana, and I'm responsible for them. And we have recently taken the Ethics Centre here in Australia to give us an idea of where the market's going and what we need to do to be best in class. So we take ethical investing and sustainability, ESG in general, very seriously, and we think over time it will be a bigger and bigger consideration for fund managers.
I couldn't agree more. One of the questions we asked, which at the ESG roundtable, was away from the standard, environmental and social issues, and towards governance and the impact of China. Overnight, we see what amounts to public disorder in Hong Kong. It seems to me that one of the issues which managers will have to face, particularly those whose portfolios are skewed to Chinese growth, and we see China being second only to India in your chart, is how they're going to respond to companies that are either dependent on or subject to Chinese government control, and what part that will play in portfolios. I'd be interested if you have a view on that, that you're prepared to share in a public forum.
I think we'd probably be cautious about making any specific comments on that. But as a general comment about sustainability and the whole area of increasing focus on governance and increasing focus on ESG related issues, this is an important consideration for us, and we embed that within our manager research process now. We're seeing increasingly managers moving in this direction as best practice. I think traditionally ESG and social responsibility has been considered to be a trade-off, that you can have that or you can have better returns within a portfolio. Our view is that moving forward, that is best practice, and that by including that within our manager research process and fund managers incorporating it within their investment thesis, we actually end up with better quality portfolios that deliver longer term outperformance and perhaps less susceptibility to shocks like what you've speculated on with regard to governance emerging out of China. That should be embedded within an investment thesis, whether it's at the managed account level or whether it's at the individual manager level.
That's a sort of great segue, Jordan, to another question here, which is whether your fund is available through the ASX, and of course Pengana International is.
Yes, it is. It's the Pengana International Equities Fund Limited. It's an ethical fund. It's got all these kind of qualities that I mentioned before. Obviously, there's an NTA, there's an NAV, and there's the price that it trades at on the exchange, which can and often is very different.
And that fund, of course, is has a history reaching back probably 15 years to one of the absolute pioneers of ethical investing.
Correct.
So yes. Michael, there's a question for you. Will your fund limit how large you grow? So I'm not sure the point of that. I guess the question is, in the advice that JANA gives, are there limits to growth? And I would have thought, as a consultant, the answer's no.
No, I mean, obviously, we don't actually have our own funds. We're a consultant. We can operate on a traditional consulting basis. That's very common within the institutional space, but we are now providing advice in terms of managed accounts, but it's very much with third-party fund managers where we're providing the asset allocation input and the manager selection input, very much on an arm's length basis, where we are trying to focus on best in breed managers that suit the specific requirements of the managed account. As I said earlier, there is no right level of passive or active or alternatives. It really depends on what the advisor is trying to achieve, what the profile is of their client base, and we will build a portfolio accordingly. And there is really no limit to that. There is a large number of very good quality fund managers out there that we can draw from. And of course, if we incorporate passive strategies within the portfolio, there is in theory no limit to those. So it's not a constraint in itself.
Yeah. All right. Now, there's one final question here, which is that, Michael, I think it was you that was talking about value style. But do you think a value style is appropriate for this stage in the market, given the the trials and tribulation that value managers have experienced over the last?
We're at a point when you look at it.
This is our last question.
Yeah, so. When you look at it from a helicopter view, value has underperformed the broader market and in particular growth stocks to about the same extent now that we saw during the tech bubble. And of course, we had a massive mean reversion that occurred within a very short period of time. So therefore, it raises the question as to whether we will see history repeat itself again. Look, I think you can look for the large goal potentially by incorporating a value style within your equity portfolio. I think the danger, of course, is that this time there are different aspects that are driving markets. The prominence of central banks, of easy capital. Yeah. That suggests that there is always a case of history perhaps rhyming but not necessarily repeating. So to answer the question specifically, yes, we would probably look to include a manager at least within an equity portfolio, Australian and global equity, that has a value tilt, understanding that on a rear view mirror basis they haven't particularly performed well, most likely. Would I actually have the entire strategy invested in that? I would be very suspicious about doing that at this point in time. I think the rationale for having a multi-manager approach within individual asset classes is to get diversity there as well. And if you put it all into value managers, why would you bother having diversity of managers? We would probably look for a bit of a cocktail selection where we incorporate core style, growth style, maybe a passive element within that also.
Great. Look, thank you very much. So Jordan, thank you. Michael, thank you. And as to the attendees, thank you for your participation. The slides and the recording will be up on the IMAP site within a day or so. Thanks very much.
Thank you.
Thank you.